Okay, here's another week of Finquinity's podcast.
Yeah, it's been
So
quite a
let's talk
while.
about so let's talk about what we kind of missed, right, over the last couple weeks or so.
Yeah. So we took the holidays off. We had kind of a what we expected in Christmas where uh things kind of sold off and stabilized for a bit. But to be fair, in our absence, we've missed quite a few big events. What I think the biggest one that comes to mind is what happened to Venezuela.
Yeah, so just to reiterate what happened to Venezuela, essentially, there's a president. His name was called Nicolas Maduro. He's been president in Venezuela for around a decade or more now. But people call him president, but what he really is basically a dictator. For people who pay attention to the news, and he hasn't been running the country really well, right? His country has been economically sanctioned. There has been a lot of chaos with refugees coming from Venezuela and going into the U.S. And as a result, the Trump administration took action in putting pressure on Maduro and his government. And long story short, they nabbed him.
Yeah.
They went to his place when we were sleeping, and they kidnapped him, and now he's in New York City, stuck in a prison somewhere, right? So what's happening now is that Venezuela is basically missing their leader, and there's a deal being cut between the U.S. and Venezuela, where Venezuela will start shipping some oil to the U.S. and the U.S. will actually make some profit from that, with the expectation that that money will be released back to the Venezuelan people, provided that the Venezuelan government actually behaves. So now, whether or not all of this is like this plan will go through, it's up in the air. But the most important thing that we want to look at here, and why we are talking about this, is how the markets are reacting. So let's talk about the Venezuelan market. We
Hmm.
never talk about it, but
Yeah.
I guess this is a great time to talk about it.
Yeah.
When Maduro was basically removed, the market went up at least 75% in the first couple of days of trading day.
Hmm.
Now, I think someone has mentioned that this is in Venezuelan bolivars. So the bolivars are basically worthless compared to US dollars.
Yeah, because
So
they had hyperinflation for a very long time.
so in terms of growth, I don't think it's worth a lot because you're still, dealing with currency with a very
Volatile.
weak currency.
Yeah.
Yeah, that's right, right? But more importantly, this translates to the global markets in several ways. First of all, the Canadian markets actually got hit a bit because there are now fears that Canada will have to compete with Venezuelan oil. So Canadian oil is a grade better than Venezuelan oil in terms of how sour it is. So it requires less refining from U.S. refineries before it gets processed into something useful. But nonetheless, there is an expectation that Venezuela uh, can contemplate and begin the process of building out the infrastructure again and potentially exporting their oil out into the wider markets, and that puts pressure on the Canadian economy. Now, as for the U.S. economy, I think what that really implies is you're putting on more expectation for disinflation. So commodities, like especially crude, can feel some pressure. Right now, though, I don't think that means much because Venezuela doesn't really export any oil. Their country has been run to the ground. So for now, it doesn't really make much of a dent on oil prices. But the future is what we're referring to in terms of the impact of the Venezuelan Maduro kidnapping situation.
Yeah, and obviously the geopolitics is very complicated and it's a whole nuanced discussion. But it's not it would be intellectually dishonest to claim that a big motivator for the action was not because of the oil. So we see that well that was most likely a large motivator, as is the same motivation for what is happening with Greenland? Now, obviously, these are just rumors that are been circulating around media, news media, Twitter media, and etc. But it's a little bit concerning. But of course, if we really get into the geopolitics, we get this the U.S. acting on command in Venezuela, what's happening currently in the Middle East with Saudi Arabia, with Iran, and all these places, it does seem like the turmoil in the world is increasing, and that um, longer terms, there are more fears of more global conflict. How have the markets responded to that? The markets really shrugged it off. The event happened. Yes, maybe there was a couple percent adjustment the market made, but otherwise the market has been in 2026 back to seeking all-time highs. I believe we are all-time highs in S&P 500. We're all-time highs in the Nasdaq, or almost all-time highs in the Nasdaq, and we are continuing to grow. It seems like if we talk about the macro regime here, despite what's happening in geopolitics, we are getting very good signals, and I think we'll talk about that too, about a growth regime here. And I think I'll let you lead the discussion on it because I know we had a very good points about the data. So go ahead.
Yeah, sure. So, something that we've been working on over the last, I think, 8 to 12 months now is developing a regime filter. So, what is a regime filter? A regime filter is essentially a system that tells you whether or not the markets as a whole is investable. So there are two labels that I would like to use. The first one is called risk off. The second one is called risk on. So risk off, is what we've have been in for a bit, in the sense that capital is basically taken off of risk assets and redeployed in more defensive assets like gold or bonds or healthcare or utilities, something more defensive, essentially. Whereas risk on is you're going all the way into tech companies or meme companies or crypto with the expectation that the growth there is much more outsized compared to owning defensive stocks during the risk on regime. Currently, this project has been in the works for quite a long time. And recently, we have been able to basically consistently identify where our environment is. And we are ready to start deploying that and integrating it with Anchor, as Anchor has been more of a tactical trading system that tells you where we're at right now, but it doesn't give you the overall picture. And we hope that by developing this regime filter, it will allow us to essentially integrate Anchor with the regime system, allowing investors and traders to make more long-term decisions that go from a couple weeks at a time to more like 3 to 6 months at a time.
Yeah, because Anchor is a tool that's agnostic of whatever ticker we want to use it against. So technically, we could use Anchor in something as devastating as SQQQQ, which is like the inverse of the Nasdaq ETF. Now, would we advise that? Absolutely not. Not for any regular day at all, any regular time period. But the idea now is that because Anchor is agnostic to the ticker, we want to know which ticker, which sector, which asset, or which kind of asset is going to do the most. Well, it's going to do well consistently, minimizing our risks. And this is why we were very motivated to bring out this regime filter. And in doing so, we have now are able to identify, as we said, growth, when we have stagflation, deflation, and maybe some, reflation or inflation. And we can basically navigate the markets as we move forward with that. Currently, based on the analysis, we had a very recent transition over back to growth. And looking at some future forecasting using Monte Carlo methods and over tens of thousands of simulations, it seems like there's a 70% chance that for the next three months, we still remain in a growth regime, and with only a 10% chance, 10-13% chance of it going to uh, deflation, where we go back to bad job data, high inflation, um, or we can go into stagflation as well. So there's a risk there. There's like about a 30% risk of it going away from risk on. But at the moment, we feel quite confident about the market being risk on in general. Now, do we have the data to support this? How have the recent reports been? Because I've been looking mostly at the algorithm side. I haven't had a great chance to look at the actual data itself. What's the data saying?
So the data has been conflicting. If we talk about immediate data, like the job data we most recently had, it wasn't super great. 50,000 jobs were created, I think, last month. And 50,000 is not a lot actually, quite flat for a labor force of over 100, 50 million or so, right? So the issue there is that there's slowly a concern now where the economy is growing, but it's growing on the side of financialization, and there's growth on the AI side, so tech stuff. Most of the growth now seems to be productivity driven, which kind of explains why we have this ridiculously high, Atlanta Fed GDP now prediction of, let's see, the most, yeah, it's around like 5.4% or 5% currently, as of the most recent estimate.
Mm.
And there's also other, data as well. There's a lot of AI spending, again, infrastructure. Now, whether or not that will continue holding up remains to be seen, because it has to hold up, it has to grow exponentially for the growth to continue. And we're seeing a lot of companies benefiting from this AI boom, right? Like Nvidia has already won. Micron has been a really recent player in getting big from this AI boom with its selling RAM as its main business. And you have companies like Tesla now that are really integrating AI and just like um, self-driving as part of their features. Now, what's happening here is you have the actual labor force that is being laid off, or there's a slowing of hiring, a freezing of hiring and firing, and a lot of the growth now that is occurring is not being derived from how many hours that are getting logged into the workforce or how many jobs created. It's mainly from just like technology advancement.
Mm.
Now, advancement growth is generally really good. You want that. That's what allows you to become richer, because a person is able to produce more and there's more output. But during that transition, you have a lot of people who don't have the necessary skill sets to optimize their performance in that new changing labor force and market conditions, and it creates a lot of friction. And that's why you often see people getting their jobs disrupted uh, around the time that the technology begins to take off, because companies begun have not fully understood what they are absorbing into their companies in terms of technology, and as a result, they're prematurely firing people because they need to cut costs. And we're actually seeing some of these companies having regret because they realize that they're creating AI slop and they have to rehire these people to do the tasks that they once did. So
Yeah.
there is a transition period.
Yeah, I think I saw a great example of this, a good analogy being made was how America utilized automation for automobiles when Ford and other like GM and those manufacturers, when they first got their hands on robotics, old school robotics like 1980s, 1990s, to make the cars completely by robots themselves, they struggled. While the Japanese were able to do the exact same to the very, very high success, and the differentiating factor between the American automobile automation, Japanese automobile automation, was that the American they tried to automate everything. So they had issues with their doors being welded shut, or they had issues with um, like small errors which caused more labor instead of reducing labor. And so I think as we look at the transition period of moving into an AI heavy world, I think many companies currently are going through this cycle where they're going to try to use AI anywhere and everywhere, but they will end up, until the right system is architected most of the time, with AI that is causing more problems than merit. Now, obviously, this is a transition period, so as you know, Ford and GM paid the expensive price of trying to innovate ahead of Japan, and not being able to do so. They will eventually figure everything out, and so will we. So it's just a matter of time of dealing with this potentially 5 year, potentially 10 year transition period. Possibly shorter, possibly longer, but I think we should probably expect that. And I think as we move forward into 2026, 2027, I think AI is going to continue to be the headlines, but I think we were talking about this just a couple days earlier. Not everyone who's doing AI is benefiting or is going to benefit. And I think the market is starting to reflect that in late 2025 and likely going into 2026, because we're looking into AI winners. Google, they they are they are the greatest example of AI winners. They had a fantastic model in Gemini 3.0. They had fantastic improvement in their cloud services, and all things around. They're even trying to capitalize some market space from Nvidia with their Ironwood TPUs, which is like their competitor to the GPU. So they're doing really well all around, but other companies, like for example Microsoft, or maybe Meta, these companies are still investing in AI, still want to do AI, especially Meta, but they are not. They haven't been putting out the results the same way Google has been. And so whereas these other companies like Microsoft and Meta, these are consolidating, or maybe they're in a bearish trend. But Google, on the other hand, is on the up and up. And so we'll see in 2026. I think we'll get to see not only raw AI being the benchmark. I think obviously that still helps in sales and in, you know, sounding cool, but really it's going to be the winners of the AI who are going to do the best in 2026. I did want
Yeah.
to I did
Yeah.
want to talk
Go
about
on.
one more thing. Well, this is brand new news. So unless you have anything else to add to that topic, I'll take us to the Powell news.
No, I was just gonna about the pivot to the Powell news.
Let's do it. Let's do it. I'll let you introduce it. Introduce it.
Right. So what's going on? So last night there has been an announcement where potentially the independence of the Fed is again threatened once more by the Trump administration. Now, we've talked about how there has been pressure by the administration for the Fed to cut rates because rate cuts are stimulative and they, in general, make the economy grow faster and allow people to borrow and spend more easily. So it's basically a sugar high that then the economy can get off them in order to grow more and get itself out of a recession. Usually that's the case. Now, in other countries that are less developed, with their institutions that are less developed, the independence of those central banks are not as established. Therefore, they're more influenced by whoever is in charge. So you had Turkey, for example, with a central bank whose chair was basically fired multiple times until the president was able to find the right one, and they started slamming rate cuts until the economy went through like a mini hyperinflation process. So that has never happened in the US. Thank goodness for that. But there are now fears in the market that the Trump administration is seeking to undermine the independence of the Fed and force the chair to make decisions on rate cuts on the whim of the president. Now, exactly what happened is basically the fact that the Department of Justice has opened an investigation into Powell for criminal charges in terms of the building renovation that they had, which is something like ridiculous. So essentially, what happened was that the Fed renovated some buildings that were very dilapidated and old, and the costs went a little bit over than the expected numbers. Now the details are a little bit washy because while the cost was greater than the expected number, it also doesn't include the fact that the renovations um, include several parts of the building. So the details are a little bit murky, and the investigation is definitely very shaky. There's weak evidence for it because what construction in the U.S. doesn't go above cost? You know what I mean.
Right.
So um, the markets have responded by selling off late last night, but it looks like it has recovered quite a bit. So we have QQ already on the green.
Hmm.
And overall, I think markets have basically shrugged it off for now. But I think they are subject to potentially reacting to it more violently if Powell gets arrested or whatever on in terms of how the investigation will go. Now, luckily, we do have some checks and balance to make sure that this will not go super far. Uh, there are individual senators who have announced that they won't approve any chair nominees if this investigation continues.
Mm.
So I think the Senate and potentially the House, so all of Congress, may actually step up and say no to this because this is a very old institution. It's been here for over 100 years now, and everyone, especially the people in the Senate and Congress, who are very wealthy, by the ways, they have a stake in making sure that equity markets and the economy runs like normal, and there's no crazy political events like the destruction of the independence of the Fed getting in the way of that.
Yeah, it's been a very, well, I wouldn't say surprising, but it at the initially when this did occur, it felt like empty threats. But seeing it go through is definitely unsettling, and so we'll continue to monitor the situation and deliver updates as to how things are going to play out. I think at the moment, yeah, as we said, the markets have shrugged it off. So we remain cautious as usual, but definitely more optimistic at the moment for the equity markets. I think that's about all the topics we had for today. Do you have any closing remarks?
Yeah, I think one more thing that we haven't talked about is just how Bitcoin has been reacting.
Oh, right. Bitcoin's been
Yeah.
strange. Very
Yeah,
strange.
Bitcoin has been being kind of strange because even though markets on a large has just been doing pretty well, you have crypto basically lagging. And what's happening here is many people are scratching their heads figuring out what's going on with Bitcoin and the entire crypto space. And I think one of the biggest takeaways from here is that the regime at large right now, while it's technically risk on, it's not euphoric yet. We don't feel euphoria. We don't feel that reckless buy everything ambience that we typically experience in risk on. And I think for now it's healthy, but I would grow a little bit concerned if we don't see Bitcoin recovering to at least $100,000,
Mm-hmm.
as it shows that maybe risk appetite has either gone down since the last risk on regime, or um, what has happened is that the capital has basically deployed itself into gold and the commodities. So we have like silver and gold taking up all the capital, and it's unknown whether or not they play a role in how crypto has been performing, because it looks like, some whales are selling. There are now rotations to other cryptocurrencies that has been adding pressure, especially with Ethereum. But just overall, you can see the crypto space just not performing as well as it should be by this point in time.
Yeah. Yeah. Yeah.
Yeah, yeah,
So,
and you can see a proxy by looking at MicroStrategies, for example, or Coinbase. They have not been doing super well, especially MicroStrategies. That one has just been, popping up and down, and there's fears that Sailor might get a margin call if Bitcoin goes any lower.
mm-hmm. Yeah, Bitcoin has been definitely coasting, and not coasting in a good way, because this is the time where the market was, going back to its peak, but Bitcoin has just been hovering. So we'll see how Bitcoin reacts. Maybe Bitcoin will have we'll see the growth that we kind of expect to see, and if not, then it's a little bit more concerning for the crypto market in general.
And I think that wraps up our week's podcast.
Yeah, it's been a long one, but to be fair, we there was a lot to catch up on, as we did miss, I think, 3 weeks of the podcast. So
Yeah.
yeah, we hope you enjoyed. If you stayed all the way, thank you so much for watching. Subscribe, leave a comment, and hope to see you again. Thank you. Bye bye.